Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the complex world of corporate finance. And today we're diving into Anchor Technology's latest quarterly report. Sometimes these filings can read like a tech manual, but we're going to cut through the jargon and see what this all means for the company and for anyone keeping tabs on them. So buckle up because we're about to decode this financial puzzle. Before we dive in, if you enjoy getting clear, no-nonsense insights from these official company reports, then make sure you hit that subscribe button. And if you want to connect with other finance enthusiasts and dig deeper, join our Discord community. The link is in the description below. Alright, let's get started with Anchor Technology's latest quarterly report, filed for the period ending the 30th of September 2025. This report gives us a snapshot of how the company is doing financially. First off, the top line for the 3 months ending the 30th of September 2025, Anchor brought in about $1.99 billion in net sales. That is up from roughly $1.86 billion in the same period last year. So sales are trending upwards, which is generally a good sign. They attribute this growth mainly to their computing and communications businesses. Think smartphones, data centers, and all the tech that keeps our digital lives running. Now let's talk about gross profit. This is what is left after they pay for the direct costs of making their products. For the same 3-month period, gross profit was about $284 million. This is up from around $272 million last year. However, their gross margin, which is gross profit as a percentage of sales, actually dipped a little from 14.6% last year to 14.3% this year. They mentioned this is partly because of higher overhead and employee costs, but also because they sold a slightly smaller proportion of products with higher material costs. So while they are selling more, their profit per dollar of sale has slightly decreased. Moving on to operating income, which is what is left after covering all operating expenses. For the 3 months ending the 30th of September 2025, it came in at about $159 million, up from $149 million the previous year. Interestingly, their operating income margin stayed steady at 8.0% for both periods. This means that even with those slightly higher costs affecting gross profit, they managed to keep their overall operating efficiency in check. Now, let's look at the bigger picture for the first 9 months of the year. Total net sales reached about $4.82 billion, an increase from $4.69 billion in the same period last year. That is a 2.8% rise, but the gross profit for these 9 months actually went down from about $686 million last year to $624 million this year. Their gross margin also dropped significantly from 14.6% to 12.9%. This is a noteworthy decline and suggests that cost pressures or shifts in their product mix are having a more pronounced effect over a longer period. They specifically mentioned that ramping up their new facility in Vietnam is contributing to these lower margins in the current year. When we look at selling, general, and administrative expenses, they actually decreased for the 9-month period, falling from about $262 million to $211 million. A big reason for this drop is a one-time financial receipt related to their Nanium acquisition. So, while sales are up for the 9 months, the profit margin is down, partly due to new facility ramp-up costs and increased general expenses not directly tied to making products. On the research and development front, expenses were pretty consistent. They spent about $42.3 million in both the 3-month periods for 2025 and 2024. For the 9-month periods, R&D spending increased slightly from $120 million to $130 million. This focus on R&D is crucial in the fast-moving tech industry, as they invest in developing new packaging and test technologies. Now, let's talk about interest expense. This went up quite a bit, from about $15.6 million to $21.2 million for the 3-month period ending the 30th of September 2025. For the 9-month period, it rose from $47.8 million to $54.8 million. This increase is mainly due to them taking on more debt, including issuing new senior notes and taking out new term loans, which they used in part to pay off older debts. So, while they are growing, they are also taking on more financial obligations. Income tax expense also increased for the 9 months ending the 30th of September 2025. It was about $59.8 million, up from $45.7 million in the prior year. This hike is driven by higher income before taxes and some specific tax expenses tied to that Nanium receipt we talked about earlier. They also mentioned that some tax incentives they rely on might expire, which could lead to higher taxes in the future. Let's shift gears to cash flow. For the 9 months ending the 30th of September 2025, their operating activities generated about $451 million in cash. This is a decrease from $551 million in the same period last year. They attribute this to changes in working capital and lower operating profits. On the investing side, they used more cash this year. They spent about $554 million on investing activities compared to $502 million last year. A big chunk of that is for property, plant, and equipment, essentially buying new tools and facilities to keep up with demand. And then there is financing activities this year. They see a big positive inflow of cash, about $519 million compared to a negative outflow of about $207 million last year. This is largely because they took on new debt, like issuing those new senior notes and term loans, which brought in significant funds, more than they spent on paying back existing debt. Now, one metric that really shows a company's financial health and flexibility is free cash flow. This is basically the cash left over after they pay for their operations and capital expenditures. For the 9 months ending the 30th of September 2025, Amkor's free cash flow turned negative, showing an outflow of about $13 million. This is a stark contrast to the previous year, when they generated a positive free cash flow of over $105 million. This negative free cash flow is a key takeaway, showing that while they are investing heavily in their future, they are currently spending more cash than they are bringing in after accounting for those investments. Looking at their liquidity, they feel confident they can meet their financial needs for the next year thanks to their cash reserves, short-term investments, and access to credit lines, totaling over $2.1 billion in cash and short-term investments as of the 30th of September 2025. A significant portion of this cash is held by their foreign subsidiaries. Now, let's talk about risks, because every company faces them. Amkor operates in the highly cyclical semiconductor industry, which is heavily influenced by global economic conditions. This means their business can swing up and down quite a bit. They also depend on a limited number of suppliers for crucial materials and equipment, making them vulnerable to supply chain disruptions. They're also making some big investments in equipment and facilities, which is great for growth, but it could hurt them if customer demand doesn't pan out as expected. They are building a new facility in Arizona, and while they've received some government funding, it comes with strings attached, demanding they meet certain construction and production milestones. Another significant risk is their lack of a backlog. This means customers can reduce or cancel orders with little notice, making it hard for Amkor to plan and manage their capacity. This also puts pressure on pricing, as they often can't lock in prices for long periods. Then there is the debt. With about $1.8 billion in debt, Amkor is pretty leveraged. This makes them more vulnerable to economic downturns and limits their financial flexibility, especially when it comes to paying dividends or making new investments. They are particularly exposed to interest rate fluctuations on their variable rate debt. Looking at leadership, a significant chunk of Amkor's stock, about 53%, is held by Susan Y. Kim and her family. This gives them a lot of control over company decisions, which could also mean a less appealing situation for minority shareholders if their interests don't align. And speaking of shareholders, they have been paying quarterly dividends, but they clearly state that this can be decreased or suspended at any time. So investors relying on that dividend income should be aware of the potential for changes. Finally, like many global companies, Amkor is exposed to risks from natural disasters, pandemics, and political instability. Their manufacturing facilities are spread across many countries, and any major disruption in one region could impact their ability to fulfill orders. They did mention an earthquake damaging one of their factories in Japan back in 2016, leading to reduced sales and costs. So, what is my take on all of this? Amkor is definitely in a critical industry, the backbone of so much of our technology. They are making strategic investments, particularly in advanced packaging and expanding their global footprint, which is smart for long-term growth, especially with demand booming in computing and automotive sectors. However, they're juggling a lot. They've taken on significant new debt, which is understandable given their expansion plans, but it does increase their financial risk. The dip in gross margins for the 9-month period, driven by costs and that new facility ramp up, is something to watch closely. Also, that negative free cash flow this year is a bit of a red flag, indicating they are spending heavily, which is expected for growth, but it means they're relying on their debt and available cash to fund operations. The lack of order backlog and customer concentration are persistent risks that could lead to significant financial swings. The key for Amkor now is not just growing sales, but also improving profitability and managing those costs effectively, while carefully navigating the inherent cyclicality of the semiconductor market. Alright, that is our breakdown of Amkor's latest report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more insights and discussions. Thanks for watching. See you next time.